Yes, good evening, students. I hope you have revised what I had asked you in the last class and hope you have started solving the question also. Yes, so let's start together directly. So I've given you the question. Let me just take you there. Okay. So Java is engaged in the development of software and providing ITES services. It has two units, Unit P and Unit Q, set up in DTA. This is the third year of operation. The export turnover, domestic turnover, duty drawback, profit on sale of import entitlements, salary paid, other expense, and net profit is given to you. And there is then some other information in respect of the expenditure in relation to the interest paid to the public financial institution. Export sales proceeds received in India are given. Export sale of 120 lakhs, including freight and insurance is given. And what is the realization amount is given, which also includes insurance and freight. For Unit Q, the export sales received and expenses paid in cash are given. So, yes, tell me the answers. Yes, Kaushiki, good evening. So start telling me the answers before I solve the question. Yes. Past students. I've given this you as a homework, right? How will you solve it? Yes, past. What we'll start with first? Just tell me that. Yes, past. I thought you would have solved and come this particular question. Yes, so first, okay, let me just solve along with you since you're not giving me the answers now. Okay, let's quickly start with it. How are we going to start this question is, so first what we are going to do here is, first we are going to start with the profits. What are the profits from the both the units? So profits and gains from business, right? So unit P, my profits are how much given? How much profit? 502. And unit Q is 753. Right? So my total profit is, first of all, 1255. 1255. Now, what information is given to me? There are certain disallowances which are given. Here it is given that expenditure of 24 lakh is in relation to interest paid to public financial institution paid on 30th November 2023. Whether that will be allowed, whether this will get allowed or not, the interest paid to the public financial institution, yes, whether we'll allow it or not. Yes, students, fast. Whether you will allow it. Yes, faster. Interest paid, whether it will get allowed or not. Allowed, disallowed. Fast. Allowed. No, Kaushiki, why it will get allowed? Come on. Allowed or not? At least this answer you should be able to give it to me. So the interest paid to the public financial institution will get disallowed. Under which section? I'm giving you the answer. At least tell me the section now. Yes, Janvi, not allowed. But under which provision it is not allowed? Under 43B. Why? Because it is paid after the due date of filing of return of income. Isn't it? So how will it get allowed? Yes, Kaushiki? It will not get allowed. So add interest paid to public financial institution after the due date. Interest paid to the public financial institution after the due date of the return of income. Right? After the due date of the return of income, which is 24 lakhs. So this will get disallowed. This will get disallowed. Okay? Are we clear about this? How about the expenses paid in cash? Yes, Janvi, I'm coming to the answer first and we are going step by step wise and I'll come to your answer, okay? So, the expenses paid in cash. What about that? Yes. Expenses paid in cash. Fast. This is very simple, isn't it? Expenses paid in cash. Yes. Yes, Janvi, correct. So expenses paid in cash will get disallowed. Add cash expenses. Disallowed under section 40A3. This we are going to write disallowed under section 43B. How much? 47 lakhs. Fine. 47 lakhs. Is that clear? So we'll add this up. So total income is coming to, there are no other additions or disallowances, 1326. Total income comes to 1326. Now we have to calculate the deduction or exemption under section 10AA. Now under section 10AA, the exemption will be available only for unit P because only this is eligible for the 10AA because this is established in SEZ, right? Now, how will you start with the calculation? I'm making a working note for that separately. Exemption under section 10AA. Yes, how will you start with that? Yes. Fast. How will you start with the calculation? We'll start with the net profit again, but the net profit of only the SEZ unit, right? Which is 502. Net profit of the SEZ unit, which is 502. Then What will we do in this particular case? Yes. How will you proceed further? So is entire 502 will be available as deduction? Yes. Yes, Janvi, you're correct. How did you get 25? I did not understand about 25. What is 25 in your calculation? Rest of the things are fine. Yes. So first of all, this 502 which is given, right? Now in this, we will need to make certain additions. We will need to make certain additions. First of all, the expense of 24 lakh is disallowed. So add expense disallowed under section 43B. So this is 24 lakh. So instead of 25, Janvi, it should be 24. Then let's go to the other information which is given. What is mentioned over here in the unit P, the export sale proceeds received in India are 1040 lakh. Export sale of 1200 lakhs includes the freight and insurance of 200 lakh and realization of 1040 lakh. Sorry, we have to go to this particular information, not this, sorry. The duty drawback which is given. Now, duty drawback of 38 which is given. What do we need to do about that? Whether duty drawback will be considered or not. What will happen to the duty drawback? As well as the profit on the sale of entitlement. Now, understand one thing, the deduction under 10AA is in respect of the profit which is derived by the eligible undertaking which is engaged in the manufacturing and export from the SEZ unit. So, deduction under 10AA, my deduction under section 10AA is in relation to profit derived. Profit which is derived by the, or profit which is derived by the eligible undertaking. By the eligible undertaking. Now understand one thing very carefully. What do we understand by the term derived? The term derived which is there, is it same as the term attributable? The answer is no. So the term derived when I talk about is a much narrower term. The profits which are derived. So income which is derived by the eligible undertaking. In this particular case, whether can we say that the duty drawback or profit on sale of the entitlements, can it be considered as the profit derived by the eligible undertaking? Because the deduction under 10A is in relation to the profit derived. So can one say this is derived from by the eligible undertaking? Yes. Yes or no? What do you think? Whether this profit on sale of entitlement or duty drawback, can it be considered? Yes, Pastor. First. Yes or no? Whether we'll consider this or whether we will reduce this. So, again, understand this particular point. The Supreme Court in Meghalaya Steel Limited, the Supreme Court in Meghalaya Steel Limited had understood or had interpreted this term derived by, and it held that there has to be a direct nexus between the profits and gains of the undertaking or business and the receipt what you are talking about. So that case was in relation to the transport subsidies or the other subsidies which are received from the government. But there the interpretation was on the term derived. In Meghalaya Steel's case, the question before the court was on the subsidies which were received. On the subsidies which were received by the government, from the government. And the court held that the subsidies were received only to reimburse the cost incurred by the assessee. The subsidies were received in order to reimburse the cost incurred by the assessee in manufacturing and selling of product. And therefore, these are in direct relation to the particular profits. And therefore, they would qualify for the deduction. But in respect of the duty drawback, now what is a duty drawback? Duty drawback are the incentives which are given by the central government in relation to the customs law. In relation to the customs law. Now, 80 IB, 10 AA, all of these sections uses the same term derived by. And therefore, all these decisions, whether Meghalaya Steel, Orchid Pharma, which is in relation to duty drawback, will equally be applicable for 10 AA. Now, in Orchid Pharma case, the Supreme Court held that these incentives which are given, the duty drawbacks are nothing but the incentives under the custom law. Right? These incentives are not profits which are derived from the eligible business. These are the ancillary profits of the undertaking. See, in the case of subsidy, the subsidy is given to reimburse the cost which is incurred by the assessee for manufacturing. So it is in relation to the direct, there's a direct relation between the profit and gains and the receipt which is there. But in the case of duty drawback, this is just an incentive which is from the customs law, which is under the customs law. Now, these are the ancillary profit. So, duty drawback is not against the cost of manufacturing of the goods. And therefore, the duty drawback receipt will not form part of the profits derived from the eligible business. Duty drawback will not form part of the profits derived from the eligible business. Are we clear? Similar is the case with the entitlement, profits on the sale of the import entitlement. All of these are ancillary profits, and therefore these will not be given or eligible for the deduction under 10 AA. So I will reduce this. So less duty drawback and less profit on sale of import entitlement. Right? So duty drawback also I will reduce, and profit on sale of import entitlement also will reduce to 38 and 24. Fine. Now, what is the profit derived by the SEZ unit? So my profit derived by SEZ unit is 464. Fine. Here you can write Orchid Pharma Supreme Court. Fine. Now my profit derived is 464. Are we all getting this? Yes, Kaushiki, you don't need to add back, you need to reduce. Because these are the incomes and therefore we need to reduce, right? And not add back. Clear? Yes, Janvi, it needs to be reduced. Janvi, I'll clear your doubt. If the interest is not paid and converted to debentures, we'll take it up later. Okay? So that is something which is an amendment which was carried out in the last Finance Act, and that we will talk about. Okay? I'll clear your doubt. Okay. So now what is the next step for you? What is the next step? Profit derived is there. What do we need to do? What do we need to do now? Yes. Yes, faster. What do we need to do now in this case? What is the formula for the deduction which is there under, or exemption which is there under 10AA? Profit derived by the SEZ unit into export turnover upon the total turnover, right? So the formula here is the exemption under section 10AA is, the exemption under section 10AA is the profits derived by SEZ unit into export turnover upon the total turnover. Now, what will be my export turnover? Yes, what will be my export turnover? Yes, faster. What will be my export turnover? Yes, the export turnover is how much? 1200. Export turnover is how much? 1200. What do we consider? So, understand one thing. Now, in relation to the 10AA, what does it say basically? So, in order to claim the deduction under 10AA, there is a condition that the export proceeds realized will be considered. The export proceeds realized will be considered, and not the entire export proceeds. Are we getting that? So when I'm talking about the export proceeds, I have to consider the export proceeds which are realized. What is the meaning of the export turnover? It means the consideration received in India in respect of the export by the undertaking. So consideration which is received in India, that is the export turnover, and not 1200. Yes, Kaushiki, correct. So we will not consider over here 1200, but we will consider the export turnover which is realized in the foreign currency, which is how much? So 464 into 1040, because export turnover realized in foreign exchange is what we need to consider. So we'll consider not 1200, but we'll consider 1040 lakh. Now this includes the insurance and freight of 140 lakh. So there is a CBDT circular to this effect that in calculating the export turnover will not include the freight, insurance, and any telecommunication charges or foreign exchange charges. So the export turnover will not include any freight, telecommunication charges, or the insurance charges. So I will reduce this particular 140 lakhs from the export turnover, right? So this will give me the export turnover of 900. Are we clear? Export turnover of the 900. Clear? What is my total turnover? What is my total turnover? What is my total turnover? Yes. What will be the total turnover in this particular case? No, Kaushiki. Yes, give me the answer for the total turnover. What will be the total turnover fast? Yes. Faster. So my total turnover will be, what is the total turnover mentioned over here? The export turnover and the total turnover is how much? Domestic turnover. It is 1400, 1200 plus 200, right? So my total turnover will be 1400 minus, I will have to reduce from my total turnover the again insurance and freight of 200. Because again there is a CBDT circular which says that the numerator and the denominator should remain the same. Why? Because if I am reducing from the export turnover, I also need the freight and insurance charges. I also need to reduce from the total turnover. So CBDT has clarified that freight, telecommunication, and insurance expenses are to be excluded both from the export turnover and total turnover while working out the deduction under 10AA. Are we clear? So therefore, my total turnover will be 1200. So what is the deduction which I am getting? It will be 348. Are we clear? So less deduction under section 1088 348. Are we getting this? And my total income will be how much? 978 lakh. All of you clear with this particular answer? Kaushiki, my total turnover is how much? 1200 plus 200. This is 1400, right? I'm not adding 200. I'm reducing this 200 lakh, which is the freight and insurance. Clear, Kaushiki? Yes, Shanvi, correct. Okay? Clear? Okay. Now, what if I make a small amendment in this question and you will have to answer me? Let's say foreign exchange loss 100 lakh. Foreign exchange gain is 200 lakhs. So what will happen in this particular case? Or let me just put it like this. Let me not put it over here. Foreign exchange gain I am writing. Foreign exchange loss I am writing over here. That the export sale includes foreign exchange charges of 100 lakh. It includes the charges on the foreign exchange of 100 lakhs. Expenses incurred in foreign exchange of 100 lakh. Or foreign exchange, wait, let me amend it also a little bit more. Includes the expenses incurred in, it includes the expenses incurred in foreign exchange of 100 lakhs. Okay. Yes. Now, what will you do in this case? Tell me the answer. First, let's talk about the foreign exchange gain. No, Kaushiki. Go back to the first class with what we started. Go back to the first class. Last Monday's class. Go back to that and give me the answer. Yes. Let me see who remembers. Let me see who remembers this. Yes. Janvi, the question is simple. I have just made an adjustment that there is also a foreign exchange gain of 200 lakhs. First, answer me about that. No, Kaushiki. As I said, go back to the Monday's class. What we had discussed that day, there was a case law that we discussed that day on this particular. No, Janvi. What did we discuss? I'm telling you the name of the case also. Now, nobody remembers because nobody is revising, right? Which was the case I'm talking about? What is written on the screen? Just read that particular case. Yes, are you able to see? No Kaushiki, there was no Wipro judgment. No Supreme Court in Cognizant Technology Solution. What was the question before the Supreme Court? Is deduction under Section 10AA available in respect of foreign exchange gain, which is in relation to the export business of the assessee? Now, do you recollect something? Yes, now do you recollect anything on that front? What did Supreme Court held? Supreme Court held that in order to allow the deduction under 10AA, we need to see whether the benefit which is earned by the assessee, the foreign exchange gain which is earned by the assessee, whether it is derived by virtue of the export made by the assessee. And the Supreme Court noted that the assessee is engaged in the export business. Therefore, any fluctuation in the foreign exchange was solely relatable to the export business of the assessee. And therefore, deduction under 10AA would be available in respect of the foreign exchange gains. Now, do you recollect anything? Yes. So therefore, if the foreign exchange gain is mentioned over here, so this is how the question can be asked in the exam as well. Right? So if there is a foreign exchange gain which is mentioned over here, I'm taking it little upwards. You will not exclude it. You will not exclude it, and you will quote the Supreme Court ruling in Cognizant Technologies. Are we getting that? So you will reduce the duty drawback, you will reduce the profit on sale of import entitlement, but you will not reduce the foreign exchange gain. Are we getting that? Yes or no? Now do you recollect? Janvi, it is already forming part of the profit. It is already forming part of the profit. Therefore, we do not need to do anything more. The net profit is after considering all of this. And that is the reason why you excluded the duty drawback and profit on sale of import entitlement. If you would have assumed that the net profit is after excluding duty drawback, why would you reduce it? So because the 502 net profit, 502 lakh, which is there, is after considering duty drawback and profit on sale of import entitlement, meaning these were included in net profit, and I don't want to give the deduction under 10AA on this, and therefore I reduced it. But the foreign exchange gain, I will not reduce from the net profit. The reason being that foreign exchange gain is eligible for deduction under 10AA. Are we clear? So just write it down over here. Eligible for deduction under 10AA. Okay. And in the bracket, write down Cognizant Technologies. Supreme Court ruling. In the bracket, write down Cognizant Technologies Supreme Court ruling. Are we clear? Okay, fine. What about the export sale includes the expenses incurred in foreign exchange of rupees 100 lakhs. What will happen in that situation? Yes, expenses in foreign exchange. There could be any, let's say, bank charges, or let's say there could be some third-party charges which are usually included for the purpose of giving you the credit while making you the payment. So what will happen in that case? Yes, Kaushiki. So foreign exchange expenses will not be allowed. So therefore, that will be reduced from the export turnover as well as the total turnover. So you will reduce 100 lakh from both the places for the foreign exchange expenses. Yes, are we clear about this particular question? Right? Yes or no? Any questions? Any doubt? Fine. Yes or no? Tell me. Any questions? Any doubt? Yes. Fine. Okay. Now, Janvi, I'll clear your doubt. What was your doubt in relation to? It was in relation to interest which is not paid but converted into the debentures. So if instead of unpaid interest, I'm converting that unpaid interest by issuing the debentures in lieu of that interest which is payable, whether it can be treated as actual payment. So explanation 3C to section 43B has clarified that interest remaining unpaid and converted into loan or any borrowing shall not be deemed to have been actually paid. Shall not be deemed to have been actually paid. So therefore, in respect of the debentures which are issued, whether it can be said that the interest is actually paid or not. In respect of the debentures, whether it is actually paid or not, can we apply the similar logic over here? So, explanation 3C says what? Explanation 3C clearly provides that in case any interest is being payable and now it has been converted into a loan or a borrowing. Then in that case, it shall not be deemed to have been actually paid. Through the Finance Act 2022, it has now been provided in this explanation. So earlier this explanation only provided that interest, if it is converted into a loan or borrowing, that will not be considered as interest is actually paid. And when the loan is repaid, only then the interest will be considered as actually paid. But there was a Supreme Court ruling. In Aqua Technologies, wherein the Supreme Court said that the interest is deductible because if the interest is converted to debentures, the interest was actually paid. In respect of debentures, since there was no mention in the explanation 3C of the word debentures, therefore the interest will be considered as paid, because the explanation 3C only provided for loan or the borrowing. Explanation 3C provides only when the interest remaining unpaid is converted into a loan or a borrowing. It doesn't talk about interest converted to debenture, and therefore the Supreme Court in a ruling held that when the interest is converted to debenture, that interest will be considered as paid. Are we clear? So, to override that particular ruling of Supreme Court, while the Finance Act 2022, the term debentures was also now added to explanation 3C. So now explanation 3C clearly provides that any interest which is payable is converted into a loan, borrowing, or debenture, or any other instrument by which the liability is deferred, the interest will not be considered as paid. Clear? So even in the case of the debentures, the interest, if it is converted to debentures, it will not be considered as paid. Only when the amount is actually paid, that time the deduction will be allowed. Are we clear? Yes or no? Okay, shall we move further towards the next question? Okay. Now question number 5. Now this is a very interesting question for you because it is on the partnership assessment as well as the some portion of the ICDs. Okay. XYZ LLP is engaged in the business of the construction. One second. Okay. And fulfill civil contracts granted by the government. The firm was constituted by X, Y, and Z HUF, represented by Mr. Z on 1/6/2022 through the registered partnership deed. Following items are debited or credited to the P&L. Here, net profit is not given, so you can write net profit reported is rupees 100 lakhs. Interest on capital payable to partners rupees 5 lakh from 1st April to 31st March at the rate of 15% per annum. Salary to partners rupees 36 lakh, including the partner in representative capacity, including to a partner in representative capacity. Interest of rupees 2 lakh paid to Mr. Z on loan provided by him in individual capacity at the rate of 16% per annum. Damages paid to the government for defects in flyover construction amounting to 15 lakh. Mark-to-market loss on unsettled derivative contract rupees 6 lakh. The contract was settled in May 23 with gain of rupees 1 lakh. Retention money held by the customer rupees 10 lakh, which will be released after 2 years of satisfactory performance. Amount received from investment in REIT rupees 10 lakh, the breakup of which is STCG on sale of property 3 lakh, rental income 4 lakh, interest from SPV 2 lakh, dividend from SPV. The SPV does not pay tax under 115BAA rupees 50,000. STCG on sale of listed shares 50,000. An amount of rupees 50 lakh was paid to rehaul the construction equipment as they had become old. Government grant of 40 lakh recovered from purchase or received for purchase of land. Interest amounting to 25,000 on fixed deposit made out of surplus fund. Other information. In September 22, the firm decided to change the PSR from earlier 1:1:1 to now X getting 40% share, Y getting 30% share, and Z getting 30% share. In connection with that, the compensation of 35 lakh was paid to Y and Z in the following manner. Land of rupees 10 lakh, stamp duty value 12, cash of 20 lakh, and shares of 5 lakh, FMV is 6 lakh. The capital balance as on 30th September 22 was XYZ 10 lakh, 15 lakh, and 5 lakh. So you're required to compute the total income. First, copy the question. Yes, Shanvi, the sale proceeds for import entitlement was credited to the P&L. Yes. Have you copied the question? Okay. Okay, let's get started then. So XYZ LLP is engaged in the business of construction and fulfilling the civil contracts granted by the government. The firm was constituted by XY and Z HUF on 1/6/2022 through the registered deed. Interest on capital payable to partners rupees 5 lakh from 1st April to 31st March at the rate of 15% per annum. So yes, tell me the answer. What will happen in this case? Yes, interest paid to the partners. What will you do? Yes, Kaushiki, correct. Disallowed about 12%, but there is one more adjustment. Yes, Janvi, correct. There is one more adjustment here. Over and above 12%. What is that adjustment? Let me see who points out. Yes. What is that adjustment? One more adjustment is there. Yes, Kaushiki, correct. Yes, very good. So what will be your answer? Yes, Janvi, calculate the answer for me. Yes, what is the answer coming to? So here the interest which is there will be allowed from 1st of June and not from 1st of April. Because when the partnership deed is signed, the partnership deed is basically signed from the 1st of June. Now, if you look at section 40, subsection B, section 40B, which talks about the interest or remuneration to the partner. First, I am talking about the interest. So what does 40B says that any interest payment authorized by the partnership deed falling after the date of such deed to the extent such interest is up to 12% per annum. What does section 40B says? 40B first of all allows you the interest only up to the 12%. Secondly, it should be authorized by the partnership deed. It should be authorized by the partnership deed. So, in case of any payment of interest which is authorized by and is in accordance with the terms of the partnership deed and relates to any period. So interest on the capital, which is 15% per annum as per the deed of partnership. What you will do in this case, you will allow only from the 1st of June. Okay, so here what I will do is, here I will do 5 lakh into 3% divided by 15%. What is 3%? 15 minus 12. Right, this will get disallowed. First of all, this will get disallowed. 5 lakh into 3% divided by 15%, this will get disallowed entirely. That's the one component. Or alternatively, what you can do is, you can disallow entire 5 lakh. 5 lakh into 12% divided by 15% into for 9 divided by 12 months. Are we getting that? Into 9 divided by 12 months is what you will finally allow. So add back 5 lakh and the allowability will be this much. Are we clear? Yes or no? Okay. Next, salary to partners of rupees 36 lakh, including to a partner in the representative capacity. What will happen in this case? Yes, what will happen to this particular amount? Yes, Kaushiki, correct. It's 10 divided by 12 and not 9. Sorry. Yes. What will happen in this case? Yes. So first we'll disallow this and then we will come to the book profit calculation. Yes, salary in representative capacity, correct, Janvi, is also allowed. So salary in representative capacity is also considered, because here the salary is given to the X, Y, and Z. Now ZHUF is being represented by Mr. Z. So he is acting in a representative capacity. So the salary which is paid to him will also be considered under 40B. So this is subject to 40B, including to the partner in representative capacity. Including to the partner in the representative capacity. Why? Because even though he is representing the HUF, but he is representing as a partner. So therefore, he should be subject to the 40B restriction. Now, who does not fall under the 40B restriction? Who does not fall under the 40B restriction? So for the remuneration, or for even that matter, the interest, there is an exception. Where an individual is a partner in a firm in a representative capacity, but the interest is paid by the firm to that individual otherwise than as a partner. So here if you see, there is another adjustment over here which I have written. The third adjustment what we are talking about. Interest of 2 lakh paid to Mr. Z on loan provided by him in individual capacity at 16% per annum interest. Whether this will be subject to 40B? Yes. Whether this will be subject to 40B? Yes, Shanvi, representative capacity, but he's getting as a salary as the partner only in a representative capacity. So that will be subject to the limit under 40B. He's not a partner in individual capacity. Yes, Kaushiki, correct. So for the third adjustment, what does explanation to 40B provides? So explanation to 40B says that where an individual is a partner in a representative capacity. In our question, Mr. Z. Interest is paid by the firm to the individual otherwise than as a partner in a representative capacity. So the interest which is being paid is on the loan taken from him, and the interest is not paid because he is a partner. The first point which was there, in that case, the interest was paid to him as a partner. Therefore, it was subject to 40B. But in the third point, the interest which is being paid to him is being paid on the loan provided by him, and not because he is a partner. So that shall not be subject to 40B. So this is not subject to 40B. So where an individual is a partner in a firm in a representative capacity, the provision of 40B will not apply because interest is paid to the partner. Interest is to pay to the partner in his personal capacity. Are we clear? Are we clear? But what we will assume here is, you will have to write a note. It is assumed that interest paid to Z is at fair market value, and therefore section 40A subsection 2, which is payment to a related party, is not attractive. So this is a related party, right? Because he is a karta of HUF, and therefore interest paid by the firm to the Z, who is a related party, that is assumed that it is at the fair market value, and therefore 40A2 is not attractive. So there will be no disallowance under 40A2. This is how you will write in your exam. Are we getting this? Yes or no? Clear? Are we clear? Yes or no? Yes? Okay. Next one is damages paid to the government for defect in flyover construction amounting to 15 lakh. Yes, what will happen in this case? Yes, damages paid to the government because the assessee had not constructed the flyover properly, so he had to pay the damages. Yes, Kaushiki, good. Why do you think it is allowed? Janvi, no. Yes, why do you think it is allowed, Kaushiki? Now we are moving little bit towards ICDs. So, why do you think it is allowed? Look at the ICDs. Have you revised ICDs? Yes, students. Why do you think, Kaushiki, it is allowed? No, not that is not the answer. No, that's not the answer. Okay, let me tell you. So first of all, tell me which ICDS is getting applicable over here. Prima facie, just look at it and tell me which ICDS do you think is applicable over here. Because that is the first note that you will have to write in the examination. Yes. Okay. So let me tell you. Yes, of course, ICDS is covered in your syllabus. Kaushiki, yes, it is very much. So here, if you look at this particular expenditure which is incurred, damages which are incurred of 15 lakh, which are paid to the government for defect found in the construction of flyover. This is not a capital expenditure. This is arising in the normal course of the business. The assessee is in the construction business. And if he does something which is of substandard quality, he has to make good by paying the damages. So this is in the normal course of the business. And therefore, the defects found in the construction of flyover is a trading loss. This is a trading loss which would be allowed under section 28(1) itself. So 28(1), what does it provide? Section 28(1), what does it provide? Section 28(1) talks about the profit and gains from the business or profession. You start with section 28(1), right? You start with section 28(1). And what does section 28(1) tells you? What does section 28(1) tells you? Yes, faster. Section 28(1) is clearly saying that the profit and gains from the business or profession. It says the income arising to any person by way of profit and gains which are carried from the business or profession carried on by him at any time during the previous year. So if you look at section 28(1), it is saying that the profits and gains. So what are the profits that we are talking about? What profits are? What are the profit? What is the definition of profit? So profit means the profits computed as per the commercial accounting principles. Profits computed as per the commercial accounting principles. So profits are not defined anywhere. Are profits defined anywhere? The answer is clearly no. The profits are never defined anywhere. What does it say? The profits and gains. So profit and gains means determined as per the commercial accounting principles. So this is my trading loss. This is my trading loss, which is in the ordinary course of business, and therefore I will allow this particular loss. I will allow this particular loss. Okay, so just write down. Just write down over here. This is allowed trading loss. Allowed in the ordinary course of business. Trading loss allowed under ordinary course of business under section 28(1). 28(1). Are we clear about this? Are we clear about this? Yes or no? Yes or no? So 28(1) is very, very clear. It says profit and gains. So what do we understand by the profit and gains? The profit and gains means as computed as per the commercial accounting principles. And accounting principles are also given under 145 subsection 2. Under 145 subsection 2, the ICDs are notified. Under 145 subsection 2, which accounting principles are notified? The ICDs are notified. So the profit and gains computed as per commercial accounting principles. So commercial accounting principles means the normal accounting principles which we are following, as well as the ICDs which are notified under 145(2). Which are notified as 145(2). Are we clear? Clear, yes or no? Okay. Next is the mark-to-market loss on unsettled derivative contract, rupees 6 lakh. The contract was settled in May 23 with the gain of rupees 1 lakh. What will happen in this case? Yes, what will happen in this case? No, Janvi, that's not correct. Yes. Faster. Okay, let me tell you now. So now this particular point which is there is in relation to the ICDS 1. What is the particular point? The mark to market loss amounting to rupees 6 lakh in respect of an unsettled derivative contract. The contract was settled in May 23 with a gain. So here, what does ICDS 1 talks about? ICDS 1 clearly says, ICDS 1 clearly says that the mark-to-market losses, which are there, ICDS 1 clearly talks about the mark-to-market losses which are there, that shall not be allowed. So ICDS 1 is very, very clear. What does ICDS 1 says? The ICDS 1 is saying just one simple thing, that any mark-to-market losses shall not be recognized unless the recognition of such loss is in accordance with the another ICDS. So, mark-to-market loss as per ICDS 1 will not be recognized. It will be recognized only at the time of the settlement. It will be recognized only at the time of the settlement. Okay, so just write down over here. Will not be recognized at the time of settlement. Fine. Okay. Here, let's take one more adjustment. Here, let's take one more adjustment, which is in relation to the kind of adjustment number 4 only. The firm received liquidated damages. It received the liquidated damages due to delay in supply of equipments from the supplier. Rupees 2 lakhs. Firm received liquidated damages due to delay in supply of equipments from the supplier, rupees 2 lakh. Okay. So what will happen in this case? Now what I'm asking you to do is, I'm asking you to take a small break. Janvi 6 lakh what? 6 lakh we will add back. Yes, correct. 6 lakh must be added back. Correct. And 1 lakh you will add in the next year. That's correct, Kaushiki. Okay. So here this 6 lakh will get added back. Okay. Similarly, here you will add back 2 lakh. Here you will add back 36 lakh. Fine. Now what I'm asking you to do is start solving this question. Meantime, you can take a break of 10 minutes also. And then we can, restart. And if you do not want break, you can just start solving the question. But I'm giving you the break of 10 minutes because this is going to be a long question. So let's take a break of 10 minutes. So what will happen, students, to the liquidated damages received which from the supplier of equipment? Yes, students. What will happen to that? Fast. What will happen? Yes, students. Come on, fast. Allowed, disallowed. Students, are you back with me? So liquidated damages which are received, this will be considered as the capital receipt. Liquidated damages will be considered as the capital receipt because this is not in the ordinary course of business. So the supplier failed to deliver the equipment on time. Therefore, this is to rectify or to compensate for that particular defect. So it is a capital receipt and not a revenue receipt. So this will be not in ordinary course of business. So it's a capital receipt. Okay. So we will reduce this. We will reduce this amount. Fine. So less 2 lakh. Retention money held by customer 10 lakh, which will be released after 2 years of satisfactory performance. What will happen in this case? Yes, what will happen in that case? Yes, faster. Retention money which is received? Yes. So first of all, understand the ICDS 3 will be applicable in this particular case, right? Because this is a construction company and ICDS 3 talks about the construction contracts. And as per ICDS 3, the contract revenue and the contract cost are recognized on the percentage of completion method. However, here we are not given any information as to what percentage is being completed at the moment. So how the net profit is arrived, that information is not given. So we'll assume that the entire revenue and cost are recognized on the percentage of completion method. Right? So you will write a note over here. Just write a note. The first note that you will write over here is, in the exam, if this kind of question comes up, is that XYZ LLP or firm is engaged in construction business. Therefore, ICDS 3 will be applicable. In absence of information on percentage of completion, it is assumed that contract revenue and contract cost are recognized on percentage of completion method. Are recognized on percentage of completion method. Are we clear? The general cost will not be recognized on percentage of completion. Only the contract revenue and contract cost which are there. The general costs which are there or the other income which are there are recognized as per the commercial principles of accounting. So other cost and income would be recognized on accrual basis as per commercial principles of accounting. Now, as far as the retention money is concerned, this would not be recognized on the percentage of completion method usually. But as far as ICDS 3 is concerned, what does ICDS 3 says? The ICDS 3 talks about the retention money. The ICDS 3 talks about even the retention money. So if you look at ICDS 3, it says that the contract revenue will include the retention money as well. But the retention money will be recognized only when there is a reasonable certainty of the ultimate collection. So ICDS 3 says that the contract revenue and contract cost are to be recognized on the percentage of completion method. So what does it say? That the contract revenue and the contract cost are to be recognized on the basis of, with reference to the stage of completion of the contract activity. Are we clear? And contract revenue includes the retention money. But the contract revenue shall be recognized only when there is a reasonable certainty of its ultimate collection. Only when there is a reasonable certainty of the ultimate collection. So in this case, the retention money which is held by the customer will be released only after 2 years of satisfactory performance. So this shall be recognized only when there is a reasonable certainty, only when there is a reasonable certainty of its collection. Are we getting that? Yes or no? So retention money will be recognized only when there is a reasonable certainty of its ultimate collection. So this we will not recognize at the moment. So as per ICDs 3, the contract revenue includes retention money and it shall be recognized only when there is reasonable certainty. Right? So we can reduce this 10 lakh. Are we clear? Next, amount received from investment in REIT, rupees 10 lakh. The breakup of which is STCG on sale of property, rental income, interest from SPV, dividend from SPV, and STCG on sale of listed share. Now, first we'll talk about the STCG on the sale of property. Yes. STCG on sale of property. No, it will not be separately taxed in CG, Kaushiki. I had asked you to revise the assessment of various entities topic. Have you all done that? Only then you will be able to answer. Yes. Capital gain on the sale of the property. What is the implication? No, Kaushiki, the assessment of various entity also includes the REIT part. Okay, let me tell you. So, capital gain on disposal of the assets by the REIT. Now, in the case of the REIT, what happens is Section 1023 FC. Section 1023 FCA provides that income of the business trust, the REIT, is exempt in the hands of the business trust if the income is from the renting or leasing of the real estate asset. So income of a business trust, the REIT, from the renting of the real asset is exempt in the hands of the business trust. Section 115 UA. Section 115 UA provides that the income which is distributed by the business trust, which is interest income or dividend income or rental income, whatever, is deemed to be the income of the unit holder. So in the case of the REIT, a REIT is considered as a pass-through entity. What is a REIT? REIT is a trust. It invests in the real estate or it invests in the companies which invest in real estate. Now, the income of the real estate investment trust is usually exempt. And it is taxed in the hands of the unit holder. And when it is taxed in the hands of the unit holder, it is taxed in the like manner, the nature of the income in the hands of the unit holder is considered in the like manner and to the same extent as the income is received by the business trust. Are we getting that? Now, income from the sale of the property. Income from the sale of the property, the capital gains which are there, the capital gains which will arise are exempt in the hands of the unit holder because the income from the capital gain, from the renting of immobile property, the income which is arriving to the REIT is exempt in the hands of the REIT. But income from the capital gains on sale of the real estate property would be taxable in the hands of the REIT and would be exempt in the hands of the unit holder. So you can write down. So this is the REIT and this is unit holder. Right? So capital gain on sale of property taxable under section 112 if it is a long-term capital gain or if it is a short-term capital gain at the maximum marginal rate. Okay, so long-term capital gain will be taxed under 112 or STCG at the maximum marginal rate. And for the unit holder, this will be exempt under section 1023 FD. Fine. So here, first of all, I have received the dividend from the real estate investment trust. Now this entire 10 lakh will not be considered as my income. It will be taxed in the hands of the unit holder. The nature of the income would be considered as same as that was in the hands of the REIT. So the nature of income in the hands of the unit holder would remain same as that in the hands of REIT. So this 3 lakh, which is STCG, will be considered as the capital gain for me. But since this is exempt under 1023 FD, this will not be taxed. So this will get reduced. So minus 3 lakh. Then comes the rental income. Then comes the rental income. Now, what about the rental income? As I said, the rental income which is there, is exempt in the hands of the REIT. The rental income which is there is exempt in the hands of the REIT. Ten 23 FCA. So this will be taxable in the hands of the unit holder. So the income which is received by the unit holder from the REIT, which is in the nature of rent, is income of the unit holder. So this will be taxed in the hands of unit holder. But tell me one particular thing. Will this rental income be taxed under the head PGBP? What do you think? So will this rental income, will you consider here in PGBP only? Are you with me? Yes or no? Are you understanding this question? I have deliberately made it very complex for you. So because in the examination only such type of questions are expected. You will not get very simple straight away questions. And that's the reason why we are having these revision classes, right? So be with me and tell me whether this rental income will you consider in the PGBP only? So where it will get considered, Kaushiki? No, that's not the correct answer, Kaushiki. Even if it is commercial, it is never in the other sources. Residential, so income from house property does not differentiate between the residential and the commercial house property. The only differentiation arises when the income, when the business of the assessee is that of letting out of the properties. If the business of the assessee is of the letting out of the property, only then it goes to PGBP. Income from even the commercial letting out is never considered as other source, Kaushiki. Are you clear? Yes. So which particular head we will consider? So understand this very carefully. Rental income from the properties owned by the REIT. Now this is rental income of whose? Is it rental income of mine? No. This is the rental income of the REIT. For the REIT, what does the provision says? that the income in the hands of the unit holder would be having the same characterization as that it was in the hands of the REIT. In the hands of the unit holder, the characterization of the income would be same as that in the hands of the REIT. The nature of income will not alter. Are we getting that? Because REIT is a pass-through entity. Now, in case of REIT, the rental income, would it be considered as IFHP or business income? Since REIT is in the business of letting out of the property, this is the business income of the REIT and not the income from house property. Even if it is a commercial property, the letting out is always chargeable under the head income from house property. But in a case where my business is of letting out itself, whether commercial or residential, the income would be taxed under business income. This is as per the Supreme Court ruling in Chennai Properties case. This is as per the Supreme Court ruling in Chennai Property case. So just write down here. Rental income in the hands of the unit holder the nature and characterization of income would be in the like manner and to the same extent as that in the hands of REIT. For a REIT, rental income, the rental income would be business income as per the principles laid out by Supreme Court in Chennai property case. Therefore, even in case of unit holder, this would be characterized in the like manner and taxed under head PGBP and taxed under the head PGBP. Okay. So this will have no effect. Fine. Interest from SPV. Interest from SPV. Yes. Interest from SPV. Now, interest from the SPV which is there. Interest income. Now, the business trust usually invest either in the real estate property directly or through a special purpose vehicle, which is a domestic company. Now, when it invests, it can invest in the form of equity shares as well as some of the borrowings or the loan, right? So when the business trust would give a loan to the SPV, it will earn the interest income. Now, this interest income which is there is again not taxable in the hands of the business trust. So this is again not taxable in the hands of trust under section again 2023 FC. Fine. So therefore, this particular income is deemed to be the income of the unit holders. This is treated as income of unit holder. This is treated as income of the unit holder. Now, interest on the loan given to the SPV, whether it would be treated as business income or income from other sources. Yes. Yes. Other income, or this will be your business income. What do you think? Faster, students. So, understand one thing. Income by way of interest. Income by way of interest which is there, it is not specifically covered under 56(2). For example, interest on securities. If the securities are held as stock in trade, then it is a business income. If the income is held as investment, it is other sources. Right? So that is interest on securities. But this is interest on loan. This is interest on loan. Now, understand one thing. Interest income which is there, which is on the loan which is given. This interest income is on the loan which is given. So what do you think? Whether this is in the nature of the business or whether this is in the nature of the interest, in the nature of the other sources. For that, you need to determine that what is the purpose for which the loan is particularly given. Okay, so when I say that the interest amount which is received by me, when I say that the interest amount which is received by me as a REIT, we are not talking again here about the unit holder. Right? We are not talking about the unit holder. So in this particular case, the interest income which is being received here is in the nature of the business only, because here the REIT is in the business of either investing in a special purpose vehicle so that the special purpose vehicle can invest in the real estate assets. And for that purpose, it may give this loan. So it is in the ordinary course of its business that it is earning this particular interest income. Right? So you can include this as business income, but also there is another viewpoint which is possible, which is to say that this is not the business. Giving loan and financing is not the business of the real estate investment trust. That is also correct. So you can write the alternative position over here. You can write the alternative position over here, because one view is that it gives this interest, it gives this loan to the SPV for the purpose of the investment in the real estate property. So if you look at the REIT regulations which are there, the REIT can invest in the commercial real estate assets either directly or through the special purpose vehicle. Either directly or through the special purpose vehicle. Right? And the REIT for that purpose can make the investment in the SPVs. The REIT for that purpose can make the investment in the SPV. And the SPV will hold the real estate property. And the SPV will hold the real estate property. So the SPVs are not engaged in any other activity other than holding and developing the property. Right? Other than holding and developing the property. So for that purpose, the REIT can invest in the SPV and it can give the loan contribution. And it is in the nature of business that this particular loan is generating the interest income. So therefore, it can be characterized as the business income of the REIT. Okay. So therefore, for a REIT, since granting of loan to the SPV is for acquiring real estate, this interest on loan is earned in ordinary course of business. Therefore, one view can be this is business income. Alternate view, interest is not business income as REIT is not engaged in financing. Right? Therefore, it would be chargeable under the head income from other sources. Okay. Chargeable under the head income from other sources. So you can write and accordingly make the adjustment. Next is dividend from SPV. The SPV does not pay tax under 115BAA. So dividend from SPV. SPV does not pay tax under section 115BAA. What will happen in this case? Yes. So in the case of the dividend income which is earned from the SPV, again, in the case where the SPV has exercised the option under 115BAA. In the case where the SPV has exercised the option under 115BAA, the dividend income is taxed. So the dividend income is any which ways, first of all, exempt in the hands of the business trust. So dividend income is exempt in the hands of the business trust. The dividend income is exempt in the hands of the business trust under section 1023 FC. Irrespective of whether the SPV has exercised the option under 115BAA or not. What is 115BAA? The concessional tax rate of 22%. Right? But for the unit holder, if the SPV is exercising the option under 115BAA, if SPV exercises the concessional tax rate under section 115BAA, then it is taxed in the hands of unit holder. Taxed in the hands of the unit holder. Now, let's say if the SPV has exercised the concessional tax rate and it is taxed in the hands of the unit holder, then whether it will be again a business income or income from other sources. What do you think? Whether it will be business income or income from other sources? Yes. Whether dividend will be business income or income from other sources. So unlike interest, no Kaushiki, here both views are not possible. Unlike interest, the dividend which is there is specifically covered under 56(2). So under 56, which is the charging section for the head income from other sources. Under 56, which is the charging section for income from other sources, in respect of the interest, it says, if the interest is not chargeable under the head PGBP, in respect of at least the securities. In respect of interest on loan, there is no specific charging under 56(2). In respect of interest on securities, it says if it is not chargeable under PGBP. So means first you have to check whether the interest on securities fall under PGBP. In case it does, then you will not come to other source. In case of interest on loan, there is no specific charging provided under 56(2). What does 56(2) says is that any other income which is not chargeable under the other head. Any other income which is not chargeable under other head means first you have to check whether the income is chargeable under any other head. If not, then only you come to E4s. Right? But in case of dividend, the income from other sources, 56(2) says dividend is specifically chargeable as income from other sources. You don't need to go to any other head of income to see whether dividend will fall there. Dividends are specifically chargeable under income from other sources. For the interest, the income from other sources, section 56 says, if it is not chargeable under other head, meaning first you have to test whether it is chargeable under other head. If yes, you don't come to EFOS. But for dividend, it says dividends are specifically chargeable under income from other sources. So you don't need to test under any other head. So dividends, if the SPV exercises the concessional tax rate under 115BAA, the dividends will be taxed in the hands of unit holder, and in that particular case, chargeable under EFOS. So chargeable under income from other sources. So you will reduce from here and take it to income from other sources. But in case the SPV does not exercises the concessional tax rate, SPV does not exercise concessional tax rate under 115BAA, right? Then in that particular case, what you will have to do? You will have to consider this dividend as exempt in the hands of unit holder. So for the REIT, it is always exempt, whether the SPV pay or does not pay the tax under 115BAA. So whether or not SPV exercises 115BAA. But for unit holder, if it is exercises option under 115BAA, then it is taxed in the hands of unit holder. Otherwise, if it does not exercise under 115BAA, it is exempt. So in this case, this will be considered as exempt. So reduce this, reduce 50K, since this is exempt. Finally, STCG on sale of listed shares. STCG on sale of listed shares. Now, in case of the STCG on the sale of the listed shares, STCG on the sale of the listed share, it would be taxable under 111A, right? So it would be taxable under the 111A in the hands of the unit holder. It would, sorry, this is, sorry, sale by the REIT and not by the unit holder, sorry. So capital gain which is arising on the short-term capital gain on the sale of the listed shares, this will be exempt in the hands of the REIT. This is again exempt under section 1023 FD. But this will be taxable in the hands of the unit holder STCG under section 111A. STCG under 111A. Are we clear? If it would have been long-term capital gain on sale of listed shares, long-term capital gain on sale of listed shares, then it will fall under 112, which is 112, and not under 112A. This will fall under 112 and not under section 112A. Are we clear? So in case of the listed share, this will fall under 112 and not under 112A. If it is an income of the, if it's a long-term capital gain of the REIT, or the long-term capital gain on the sale of listed shares, it will fall under the 112. Are we clear? Any doubt, any questions till now? Clear? Yes or no? So on the listed shares, what will we have to do? 112. Okay. Clear? Any doubt? Any questions? So here again, this will be considered here from the business income. You will reduce and put it to the capital gain. This will be taxed under the head capital gain. Are we clear? Any questions? Any doubt? Clear? Right? Yes or no? Because Kaushiki, the provision under 115, under 11 UA, which is there for the REIT, which is there, basically 115 UA provision, if you read it out, what does it say? If you read out 115 UA, 115 UA section is applicable in case of the tax on the income of the unit holder deriving the income from the business trust. So 115 UA is a specific provision which is applicable for the income of the unit holder from the business trust. And it says that the tax under 115 UA, other than the income which is chargeable under the 111A or 112, the other income will be charged to tax at the maximum marginal rate. The other income will be charged to tax at the maximum marginal rate. So in case there is a long-term capital gain, it is subject to 112 for the other shares, for the unlisted shares. For the listed shares, 112A is applicable, right? But 112A is not carved out as an exception from 115 UA. 115 UA says that the income of the unit holder would be charged at the maximum marginal rate other than the income which is covered under 111A and section 112. Are we getting that? Now under 112, every other type of long-term capital gain is covered. Every other type of long-term capital gain is covered, right? So in that particular case, the 112A is specifically not covered here. So any other income will be taxable at maximum marginal rate. Are we clear? Okay. Clear, Kaushiki? Okay. Now let's move further. An amount of rupees 50 lakh was paid to rehaul the construction equipment as they had become old. What you will do in this case? Yes. What you will do in this particular case? Whether allowed, disallowed, which provision are we referring to? Yes, Kaushiki, correct. So we need to add it in the cost. Why? Because ICDS 5. So ICDS 5, which is for the tangible assets, talks about improvements and repairs to the fixed assets. It says that where an expenditure increases the future benefits from the existing asset beyond its previous performance, then you need to add to the cost of the asset. So if the expenditure enables you to increase the future performance of the asset and the future benefits from the existing asset, then you need to add it to the actual cost. So an expenditure enhancing future performance of the asset. So add to the actual cost of asset. So from here, this will get reduced. So minus 50 lakh. Fine. Government grant of rupees 40 lakh received from purchase of land. What will happen in this case? But Kaushiki, this is a non-depreciable asset. You reduce from the actual cost when it's a depreciable asset. This is a non-depreciable asset. So what will we do in this case? Yes. So again, we need to refer to the ICDs 8. We need to refer to the ICDs 8, which is the government grant. So ICDs 8, which is the government grant. What does it say? ICDs 8 says, where the government grant relates to a non-depreciable asset. Where the government grant relates to the non-depreciable asset, then in that particular case, that amount, the grant, will be recognized as income over the period over which the cost of the meeting the obligation with which grant is received is charged as the expense. Meaning what? Meaning it is saying that the government grant will be recognized as the income, but it shall be recognized over the periods over which the cost is cost to fulfill that obligation with which the grant is received. If the grant is received with certain conditions, so the expenses which are required to fulfill those conditions, as and when those expenses are recognized, the grant will be recognized as income. But here, since no information is given with respect to the expenses or the obligations to be fulfilled and the expenses in relation to that, so therefore, we will recognize this as income of this year itself, right? But the grant in respect of the non-depreciable asset has to be recognized as the income. In respect of the depreciable asset, the grant has to be reduced from the book value, from the written down value, from the block of asset. Right? It has to be reduced from the block of asset. But in case it is a non-depreciable asset, then this needs to be considered as your income. Right? This needs to be considered as income. Even under section 2, subsection 24, which is the definition of your income, section 2, subsection 24 also provides that the income includes any grant or any cash incentive or any duty drawback or any subsidy which is received from the government or any other authority other than the subsidy which is reduced from the actual cost of the depreciable asset. So that means 224 includes the grant received from the grant received for the non-depreciable asset. So income definition includes the grant which is received for the non-depreciable asset. For the depreciable asset, you have to reduce from the actual cost. So just write down grant for non-depreciable asset recognized as income. Grant for non-depreciable asset recognized as income. Section 224 and ICDs 8 both talks about it. For depreciable asset, for grant on depreciable asset reduced from actual cost. Explanation 10 to section 43(1) and ICDs 8. Fine. Last one. Interest amounting to rupees 25,000 on fixed deposit made out of surplus fund. Yes. So what will happen in this case? Yes, please. So surplus funds are deposited what will happen in this particular case? Other sources. Yes, correct. So the surplus funds which are deposited with the bank and interest is earned on that. So it is income from other sources. So this will be income from other sources. Now let's say, for example, let me give you one more adjustment. Let's say, for example, instead of this surplus fund, if let's say the interest on fixed deposit was earned, let's say interest on fixed deposit made with the bank as margin money for obtaining the guarantee required by the state government on obtaining particular contract, rupees 5 lakh. So whether this will be income from other sources still? Whether this will be still income from other sources? Yes, Kaushiki, correct. So this will be PGBP and not income from other sources. This will be PGBP. Now you will ask, ma'am, why the difference? Because in the first case, when the surplus money was deposited, you said that this is going to be my income from other sources, right? And now you are saying that no, this is going to be the PGBP because it's a margin money. So see, the fixed deposit is made with the bank to obtain that particular contract. And for that contract, the guarantee needs to be obtained. And for requiring that guarantee, for obtaining that guarantee from the bank, the margin money had to be kept with the bank. So this fixed deposit is a margin money which is kept with the bank for obtaining a guarantee in order for the assessee to secure a particular contract. So the interest income which is earned is inextricably linked to the business of the assessee and therefore has to be treated as business income. So you can write here, the interest income is earned on the fixed deposit kept as margin money for obtaining the guarantee. To secure the contract. So this is inextricably linked to business and therefore PGBP. Fine. Now we are done with all of this. What else is remaining? Other information? Just keep it pending because that we will do it in the next class. That is in relation to the capital gain, which you will revise and come and then only we'll solve it. But there is one more adjustment which is left. What is that? What did you forget? After solving the entire question, you forgot something. What is that? What is that? Past. One adjustment. What did you forget? Very important point. Yes, past. Yes, correct, Kaushiki. That is the salary calculation of the remuneration. So what is the remuneration that is allowed to the partner? What is the remuneration that is allowed to the partner? What is the remuneration which is allowed to the partner? Yes, come on, tell me fast. How do you calculate the remuneration to the partners? Remuneration to the partners. Section 40, subsection B. What is the remuneration? Yes, Kaushiki. Correct. So the remuneration paid to working partners. This is allowed only to the working partners. Let's say if I had given you in the question that let's say Y is a non-working partner, then would you have allowed the remuneration to him? The answer is no. So remember this thing, that the remuneration is allowed to the working partner, which is authorized by and in accordance with the partnership deed. This also should fall after the date of the partnership deed, right? So what is the remuneration which is allowed? On first 3 lakh. On first 3 lakh of the book profit. On first 3 lakh of the book profit, what is it allowed? Or in a case of loss, if there is a loss or if there is a book profit, so first 3 lakh of the book profit, rupees 1.5 lakh or 90% of the book profit, whichever is higher. Whichever is higher. On balance book profit, this is 60%. This is 60%. And what do we mean by the term book profit? Book profit means what? Book profit means your net profit. Book profit means the net profit which is computed in the manner laid down in this particular chapter. Laid down as per PGBP. So net profit computed as per provisions of PGBP chapter. Right? Net profit computed as per the provisions of the PGBP chapter, meaning you will not consider any business losses at the moment. You may consider the unabsorbed depreciation, because unabsorbed depreciation is considered as the current year depreciation under 32(2). Let's say, for example, if I would have given you here in the adjustments, let me give you the adjustment B. Let's say UAD rupees 1 lakh and brought forward business loss, let's say 2 lakh. So here, for the purpose of the book profit, I will not consider business loss. Right? I will not consider the income chargeable under other heads. So that will also not be considered. But what you will consider is UAD will be considered as it is treated as current year depreciation under section 32 subsection 2. So while calculating the net profit, you will minus the UAD. Are we clear? So therefore, in this case, you will consider this 100 lakhs, then make all these adjustments, including the UAD, you will reduce, and then finally you will calculate as per this particular quantum which is given. Are we getting that? Yes or no? Yes, any doubt till now? Yes, any questions, any doubt? Okay. Now what I want you to do is, this other information which is given is in relation to the capital gain chapter. Now I want you in the next class to revise one, the capital gain. Second, charitable trust, because we are going to solve a question on that. So charitable trust and the this particular capital gain chapter, income from other sources chapter, and transfer pricing. This you will revise because in the next class, we'll be solving the questions around these areas. Are we clear? Yes or no? So will you revise and come and solve this other information part because that is totally in relation to the capital gain part. Yes? Will you revise and come before the next class? So what all we have now till now covered, we have covered the PGBP, we have covered the ICDs, we have covered the assessment of various entities. We have also covered in the assessment of various entity, the partnership profits, the set off of losses also we have considered. We have considered the specific deductions, chapter 6A deduction, 10AA, all of that we have considered. Now in the next class, we are going to deal with the capital gain, one sum on that, the charitable trust, and second, lastly, we will consider one sum from the transfer pricing. Are we clear? Yes. So will you please revise and come? Okay. So please revise this question also because here we have covered numerous adjustments in a comprehensive manner. Okay. So thank you so much and we'll meet in the next class. Thank you.